The first rates then on your screens, and we're holding on to that 19,350 print for now. It is a downtake of nearly about 0.5% that we are staring at. Let's see what ITC is up to while the Nifty settles down a little bit. The cigarette volumes have come in higher by 9 to 10% versus what the street was anticipating at about 7 to 8% or so, and the sales have managed to cross the 5,000 crore rupee mark. ITC holds out around that 450 odd level in trade. Of course, it's the demerger swap ratio as well, 1:10, that also is impacting the stock price movement this morning. There's Infosys as well, which has backed orders worth more than $1.6 billion, and that's the other stock which is holding up now at 1,400 odd levels, 1% higher for Infy as we speak right now. SEBI has barred promoters Puneet Goenka as well as Subhash Chandra to hold the KMP in group companies till the probe is actually completed. Z holds up 2% as we speak right now. And Interglobe Aviation as well, wherein the Gangwal family is understood to have sold a block of 3,700 crore rupees. The floor price at 5.8% discount at the current market price, 4.5% of a loss coming in on Interglobe Aviation this morning as we speak right now. Some of the other buzzing names as well from Monday, let's check in on those. NMDC, you just heard from the management on the channel about their numbers. This was a sure buzzer on Monday. Can't see the follow through, at least in the first initial rates. 118, a downtick of about 0.5%. There was of course PVR Inox, which gapped up 4.5% and stood with its gains. Another 1% off a move. It's 1700 plus levels now on PVR Inox as we speak. HAL, Trent, Polycab, these were a couple of other buzzers in trade, but not such a great day for some of the metal majors like Jindal Steel, SAIL, Nalco. So let's see whether that trend continues on these names or not, especially in the light of China actually cutting rates to boost economic recovery. This of course could have its bearing on how metals as a pack moves, and you can see red pretty much across the board. So 0.5% lower, that's where we are settling in at for the Nifty. Kunal, the first trades that you're punching in?
Looks attractive because the stock has been extremely oversold. It's corrected from 2750 to 2500 levels. So the risk reward to initiate a buy is pretty lucrative at current levels. So would go for a long on HUL.
All right, Naresh, let's get in your thoughts then. What's the first trade that you're punching in this morning?
So continue like NMDC, a flat open around 117, 118 is a buy zone, looking at a move towards 125 over the short term.
All right, NMDC, HUL, those are the first trades of our chartists. But we have a special guest joining in, Hiren Ved, CEO, Director and CIO, Alchemy Capital Management. Nikunj in conversation with him. Nikunj?
Hello and welcome to a brand new show of Market Makers. We may be at a relative scale of outperformance given what is happening in the recent world. But given that now markets are perhaps reaching that phase where valuations are not exactly cheap, triggers are absent, and major part of the re-rating in individual stock has already happened, where do we go from here? What's next in terms of a trigger? What's next in terms of a theme? And what is the way forward for some of the consumer tech and fintech stock after the grand comeback in the first half of 2023? Let's take some of these pointers forward with Hiren Ved of Alchemy Asset Management. Hiren, fantastic to have you back. Thank you for joining us.
Thanks, Nikunj. Always a pleasure.
Likewise. It's turning out to be a good year.
Yes.
When the year started, nobody anticipated any kind of... nobody was prepared for a double-digit gains on index and even on individual stocks. But last 4-5 months, I think we've seen a breathtaking rally.
Yes. And you said it right. Not only a breathtaking rally, but the breadth of the rally has been pretty good, right? Yeah, I think from the Feb-March lows, double-digit plus, right? In the both Nifty and especially small and mid cap have done exceedingly well. But Nikunj, if you look at a slightly longer term perspective, let's take October 21, which is when markets last peaked, right? The broad markets peaked. It also pretty much coincided with the Fed starting to raise rates, right? That is, I think in November was the first time in 21 when the Fed started talking about raising rates. And the broad markets corrected, right? If you look from October 21 to today, the rise in the market will look less spectacular. And the Nifty, for example, is up 3% CAGR over 21 months from October till date, October 21 to date. The mid cap index is up 7-8% and the small cap index is also up 7-8% CAGR. So essentially, you've broken out of a long consolidation phase between October and March this year, and then from April onwards, you've seen a surge. It's also because earnings breadth improved, because 22-23 was a very tough year for earnings, especially the first 9 months after the Russia-Ukraine war. Commodity prices just completely went off the charts, and all manufacturing companies outside of financials was the only pack which did well in terms of earnings, because they had the best metrics that you could think of, best NIMs, no credit cost, reasonably healthy, But outside of financials, there was a big impact on earnings because of rising commodity costs. That was also one of the reasons that you had a double whammy of rising rates globally and falling margins, which is why your broad markets didn't do well in 22. But that is now reversing in 23. You can say that while you don't have earnings, while you don't have rate cuts coming as yet, that's kind of got delayed, but at least you are peaking broadly. So you're not going to see rates much higher from here than where you are. And earnings are coming back because commodity prices are starting to come down. So I think this combination has worked for the broader markets. So I'm not surprised that, we always have this recency bias, because if in 3-4 months the markets really go up, we feel, oh, markets like too high. But as I said, if you take a slightly longer term view, it's not done anything great for the last 22 months, right? Also, if you look at another statistic, right, if you take the BSE 500 earnings pre-COVID, March 2020, I think the figure is somewhere in the region of 4.5 lakh crores. If you take March 23, those same top 500 companies, it's at 11 lakh plus crores. So your earnings have more than doubled, but Nifty hasn't doubled from 12 to 24 yet, right? So I think you have to keep some of these things into perspective, that I don't think, yes, we are not cheap, we are not very cheap, but we aren't exorbitantly expensive as well. And there's just so much of gloomy news outside of India that, you feel that how come markets are so resilient?
Okay. Now let's look at 3 factors which have changed post April. One is liquidity. That good old go to sell India, go to China trade. Every time, I don't know why people do it, but every time they've done that, they've come back and realized they've only come back to buy Indian stocks at higher levels, which is liquidity. That has reversed.
Yeah.
Do you think the broader trend for 2023 could be that, barring few bad days of outflows, in general the trend for global liquidity will be strong and it would be favoring India?
Undoubtedly. I think, the China trade is really not happening. Everybody tried it early this year. They thought with the reopening of China, there'll be a big comeback, and it all fizzled out. And now increasingly the real estate problems in China, they're trying to artificially stimulate the economy, but it's just not working. And then on top of that, there is the whole geopolitics with the US, etc., which is not helping either, right? But sometimes what happens, Nikunj, is that we all might be very happy that money is flowing out of China, and where else will it go? But when nothing else is doing well and only India is doing well, then India starts on a relative basis seem to be trading at a significant premium to other emerging markets, right? And that also sometimes becomes a constraint, because there may be a set of global investors who may say, yes, we love India, structural growth story is superb, but look at the premium to other emerging markets. Now we as Indians would want to justify, and rightly so, why India should trade at a premium. But sometimes when everything else doesn't do so well, it's always good news for India, because our premium goes up, right?
But this year in Nasdaq is also done well, 44%
Yes.
up. So while we may say that, okay, India is up, it's been a good year for global equities in general, barring one or two markets here or there.
Yeah, in fact, India in dollar terms is underperformed.
Exactly,
right?
exactly.
I mean,
So
it's not that.
there's nothing to get excited about.
Yeah, I mean, that's why I said in nominal terms, we are getting very excited about, because we are coming from a fairly low base and depressed base of 2022. I don't think we've done anything great, earth-shaking. I think the best of the rally is still ahead of us.
So if I say India is like a sea-facing flat in Nariman Point, it will always command a premium because of the positioning of the flat.
Yes.
And that is the positioning of Indian economy, Indian stock market. So it will always command at a premium.
Yes.
So everybody thinks that China is cheap.
Yeah.
And others ought to offer better value. Remember, Nariman Point has commanded a premium, will always command a premium.
Absolutely. And I think we have to be less defensive about this fact.
Exactly.
You know, we become too defensive when all the strategists come and write reports and say, oh, India is trading at a significant premium, and you know, there is a lot of value in China. Yeah, I mean, you know, we've seen markets that
Yeah, please take it.
we see markets that have come into its own. We've had those markets trade at a premium for decades together. And I
Japan
think
traded, US traded,
Japan
China
traded, US traded, China traded in a similar manner. It could well be India's decade now. It is. It not could be, it is.
Okay.
So I think we have to get used to this.
So the messaging for our viewers who are watching the show, that okay, you look at market from point to point, which is April low to now, it's a double-digit rally. But if you stretch the timeline, maybe add in one more year, maybe add in 4 more, 5 more quarters, it's actually not a powerful rally, which means that there is no euphoria, there is no excitement, and there is no bubble in the market. That's the headline message number 1.
Yes. Just to add, Nikunj, to that point and to the viewers as well, right? If you look at the Nifty mid cap and the Nifty small cap 1 year forward earnings, right?
This is FY25.
FY25.
Okay.
You are today trading at lower levels than October 21 levels for all the 3 indices, and we are exactly near 5-year averages. So you do the math, the 5-year Nifty forward and where we are trading today, we are at near 5-year averages. Now if we believe that the next 5 years our earnings growth, our return on equity is going to be worse off than the last 5 years, then it's a different question. But I think otherwise, right, the next 5 years could be better than what we've seen in the last 5 years, because last 5 years we've seen a lot of disruption, COVID and so on and so forth. I think we are not terribly expensive at all. We are trading at 5-year averages.
So let's do a maths here. If earnings are expected to grow in the range of about 12 to 14%, 12 being the base and 14 being the optimistic number, can one expect that in 3.5 to 4 years, which is simple rate of compounding, the Sensex should be close to 1 lakh? It may not be above 1 lakh, it may be just below 1 lakh, but there is a serious possibility and a probability that 3 to 4 years Sensex 1 lakh ho jayega.
I have no doubt, right? And again, when we talk about earnings compounding, Nikunj, we talk about the Nifty, right, typically. My sense is that the broader markets, if you look at the NSE 500 or the BSE 500, my sense is that the broader markets earnings could compound faster than the Nifty. Because the Nifty has a lot of heavyweights and you know, they may compound at 14-15%, but the smaller companies might compound faster. Manufacturing, See, the representation of the sectors which are likely to outperform over the next 5-7 years in the Nifty is far lower. Like auto is, auto and pharma are like have virtually no weight in the index. But if autos outperform next 5 year or manufacturing outperforms, they could run at a faster pace than what the Nifty could run. So the Nifty representation is so overloaded in favor of financials that the smaller and the broader manufacturing side of the market could grow much faster in earnings.
At what rate do you expect your portfolio earnings to compound? Not the pricing, but the portfolio earnings to compound.
So if you look at our portfolio today for the next 2 years, CAGR is 25% earnings growth.
25%.
25%.
What are your top
earnings
holdings?
growth. Sorry?
What are your top holdings where you expect a 25% CAGR earnings growth?
So we have everything from large, mid and small cap, Nikunj. Yes, we have NBFCs and financials at the top, but we also have consumer companies like United Spirits is part of my top 5.
The numbers are just
Varun
not
Beverages are top 5. And we have now stocks like Larsen, which are way up in the pecking order, right? Because we believe that the capital, both the government and private capex will play off. We have technology, mid-cap tech in our top 5-10, right? So we have, we don't look like the index at all in our top 5-10. And then over time we have invested in a lot of manufacturing companies, bearing companies, capital goods, power equipment, and so on and so forth. We think there the earnings could be much faster. And as I said, our weighted average portfolio earnings growth is going to be on top, ahead of 25% for the next 2 years.
Is L&T the only Nifty 50 company in your top 5?
No, we have others. We have private. We have ICICI Bank. We have Bajaj Finance and L&T. These are probably the 3 from the Nifty that we have. Everything else is outside the Nifty.
I distinctly remember that when we met in December, you said you bought into Zomato, you
Yes.
bought into Paytm.
Yeah.
And it must be a painful position because post-December, those stocks, they fell another 20%, another 25%. But the tide has turned.
Yes.
For Paytm, Italy, and for Zomato, and for Policy Bazaar. Are best of the gains behind them?
No, I think the story is just about getting started.
For all of them, or just anything specific here?
No, I think specifically, we are bullish on Paytm and Zomato. We also like Policy Bazaar. We are also playing some of these through Info Edge because that has a cash flow business plus a holding in that, right? But I think that these businesses have a long runway for growth. Just like the FMCG companies in the 80s had a long runway for growth, right? I can't see too many businesses compounding at 30-35% top line.
Very few actually.
Very few, right? But Zomato could compound top line for the next couple of years. And if they start becoming more profitable than what they are today, then I think that's where the value, that's where the money is going to be made.
Operating leverage will kick in.
Operating leverage should kick in. They're becoming more disciplined about their capital allocation. They are focusing on profitability and cash flows. And they have leading positions in their respective sectors. I mean, it's a duopoly now between Swiggy and Zomato. And I think Zomato has a slight edge over Swiggy. And in payments, Paytm has created a fantastic platform. And everybody is now realizing the value of payments, though it doesn't make great money, it makes some money. But it's what you cross-sell to your payments customer is where you actually make money, and that's what Paytm is doing by lending. There are 8-9 NBFCs behind that, but they have the platform and the data to lend to these individuals, and they're building a book and they're making money on that. Right.
The market cap of a Zomato is almost $9-10 billion. Paytm nearing there in terms of a market cap. So while the growth may be visible, and in terms of a need and what they would do in terms of creating a community and also ecosystem is going to be very large. But if you're looking at the market caps, 70,000 crore, nearing $10 billion for Zomato, aren't these stocks then priced to perfection purely based on the market cap versus the size of the opportunity?
Nikunj, we have to, if we are talking about our economy being 5 and 6 trillion,
Okay.
what is 50, 60, 70,000 crores? We have to grow out of these numbers. We are not
Think big.
in the 2000s, right, where a 1 lakh crore market cap seemed so big, right? By international standards, our large caps are mid caps, right? Even the Reliances of the world at 16, I mean, the real big caps in the US have crossed $1 trillion in market cap, right? You have to look at it in the context of first of all, if for the whole of the country there are going to be only 2 food delivery companies, then the opportunity is much bigger, right?
Yeah.
And today maybe 100 million customers out of 1.4 billion are using a service like this. 5 years out, 200 million, 250 million of the middle class households that we talk about might use that, and then the frequency of use might improve. So I think there is significant runway for growth, right? I think the problem was that the market caps at which they went public were wrong, clearly, right? Because the valuations in post-COVID in 2021 for everything that was digital was just way out of whack. I think we've come down, there's more rationality in valuations. So you have to look at from here where, and I think there is reasonable runway for growth.
Okay, we spoke about the following. You like manufacturing?
Yeah.
You were bullish on the EV capex and you were bullish on the energy transition and some select consumer tech names which
Yes.
you already have discussed, Paytm and Zomato. How are you betting on manufacturing? Is L&T the easiest way to bet on manufacturing?
No, Nikunj, I think, manufacturing is a very broad term. My sense is that the kind of sectors which led between 2003 to 2008, but with a couple of more sectors added in this cycle, like you mentioned, electric vehicles and that entire ecosystem, or energy transition and that entire ecosystem, right? Infrastructure, which is being driven by the government at this point in time, whether it is railways, defense, etc. So manufacturing is a very broad theme. I mean, when you say EV, you don't have to necessarily go and directly buy an EV OEM. You could buy an ancillary which is supplying or which is very well positioned.
Have you done that?
EV. We've done that. I mean, Sundaram Fasteners has, have $400 million of orders for supplying EV.
You've been holding on to Sundaram Fasteners for more than 10 years now, right?
Yes. And they've transitioned pretty well.
I was looking at data, the CAGR return in last 20 years for Sundaram Fasteners is 20%.
Yeah.
One of the most underappreciated stock where they're giving you a 20% return without dilution. And
At all.
Yeah, and nothing really great, iconic about that business. But they keep on doing the same thing again and again, and they have this habit of getting it right.
I think they're a great manufacturing company. People forget that when you looked at the manufacturing icons in India, Sundaram Fasteners, stands out with all 17 plants having won the Deming Award, which is the highest quality award that you can think of. And they were largely a commercial vehicle fastener company. Today, that's just 20% of the business, right? They do fasteners for windmills, right? So that's, for me, an indirect way to play the energy transition. You may not buy the end equipment guy, but you're buying into somebody who's supplying into renewable energy. They're already supplying to EVs, they're already supplying to fasteners to the windmills, and they will do more in aerospace, etc. You have the same manufacturing skill sets, but you have far more opportunities to earn your revenue from. So I think a lot of those kind of plays have found our way into our, you look at the bearing companies, right? I mean, they also go in auto, but then they also go in railways and industrial. So you can play all three sectors by buying into one bearing company, right?
Would you make manufacturing and alternate energy as 20-25% of your core portfolio? Like, could it be the outsized bet, let's say, you took in NBFCs in 2010 and 2015? Could this be the core of your portfolio?
I think that entire cohort of capital goods, infrastructure, energy, auto ancillaries, defense, all of that put together is clearly the largest portion of the portfolio. You call it industrials if you have to, right, which is manufacturing or industrials. I think that is a core of our portfolio now for the next couple of years.
Are you bullish on L&T because you bullish on L&T because of the capex, but L&T also has IT.
Yeah.
And those IT companies are going through their own cycle of disruptive AI impact. What is your view there?
Well, now 35% of the value of L&T comes from the investments that they made. As a shareholder of L&T, I'm happy they made investments in those businesses because they are not working capital intensive. In fact, they throw cash flows and they are compounding at 15-20% a year. So 35% of L&T's value is compounding nicely at 15, 20, 25% a year. I'm quite happy. I'm not as bearish on tech as most people are. Yes, we are going through a slowdown patch, but my sense is that AI will actually accelerate tech spending. I think that every company will have to adapt AI into their processes, and they will need products and tools and Indian IT services companies to help them to use that AI into their businesses, right? So I think AI with a little bit of lag, and we are already starting to see that. If you look at some of the hyperscalers in the US, they are talking about cloud spending coming back in a big way. Yes, everybody was a little cautious because we made such a big din about a recession in the US and Europe, and therefore people just held back decision making, they held back a little bit of budgets. But the US economy isn't slowing down. Even the last data that came yesterday was better than what most people expected. So I think in a quarter or two, tech spending will come back because you can't hold it back for too long a period of time. But I think otherwise L&T is changed dramatically from being an asset owner. They are again becoming an asset light business. They are in every area that we are bullish on, whether it is railways, defense. They are also doing stuff in hydrogen, oil and gas, EPC, renewables, building construction, and they are still one of the few companies who can do complex, large infrastructure projects.
Okay, that's Hiren Vaid from Alchemy Capital talking about a whole host of sectors and his opinion on individual stocks as well. Let's take stock of where the market has settled in at before we move forward. It was a bit of a tempered start for us. Tempered it continues to be, but we've not seen a sharpish move as opposed to what the GIFT Nifty was indicating, adjusted for yesterday when we had a trading off. ITC is right up there, a good 1.5% of a move coming in there. There's Polycab, which is seeing nice follow through. LTTS, Oracle Finance, Coforge. Midcap IT is the one which is seeing a good solid comeback. On the other hand, you've got Interglobe Aviation, which is of course down 4.25%, and those block deals have happened. Indiabulls Housing, after its numbers, that's tanked about almost 6%. Crompton is down. Hindustan Copper is taking a sharp plunge down, almost a 9% cut coming in there. And then Idea also, which is lower by about 2.5% as we speak. Remember, the losses have now expanded in the first quarter to 7,840 crore rupees. And now that stock is just struggling sub that 8 rupee per share mark. But let's move on and let's talk about a very interesting strategy note from the House of ICICI Securities on GARP stocks. So let me welcome on board Vinod Karki, the head of strategy, joining in on the show right now. Vinod, hi, morning. Good to have you on the show. GARP, if I'm pronouncing that correctly, first walk us through how are these stocks screened and what's the rationale behind identifying this strategy?
Yeah, that's absolutely right. And it's growth at reasonable price, basically. That's the acronym. It's a global this thing. I mean, it's widely acknowledged as a strategy. So basically, what we're trying to find here is, companies which are showing sustainable growth, but at the same time are at reasonable valuations. Because we have seen that sustainable high quality growth companies typically tend to trade at very high valuations. And market seldom, is giving out free lunches. But so therefore, we have put in your checks and balances to see whether these companies are indeed, GARP, but not value traps, basically. So for that, we check whether they are undergoing any severe downgrades, or the market is just ignoring their growth potential because it sees something else. So all those checks and balances are there. But broadly, it's trying to find those cohorts, those pockets where market is kind of, maybe mispricing to some extent, that the growth is good, sustainable, good quality ROE and things like that. But the valuations are reasonable overall.
Sure. Vinod, is there a market cap bias, or these bunch of stocks are across market cap categories?
Yeah, so if you see the list, I mean, we have gone across market. I mean, so you will find companies from large cap, mid cap, small cap over there, where such factors are exhibited by these companies. So there are a bunch of companies from small cap, mid cap, large cap, everyone is there from all the categories.
Okay, so let's start off with the large cap list, and I can identify an Axis as well as IndusInd Bank there amongst the large cap names. Help us understand, why is it that you find value in these names?
Yeah, so if you look at these the companies broadly, I mean, be it large, be it small cap, one thing you will notice is the themes from where these companies are emerging. And we firmly believe that stocks only reflect what is coming out of the broader economic demand environment. So we have been saying that the economic revival is being led by the investment, manufacturing, and discretionary consumption space largely. And so these are the stocks which are kind of exhibiting the growth which is sustainable, reasonably higher than nominal GDP. And as I said, the support of, the financing part of the economy actually supports the investment and discretionary consumption. So that's where the financials come in. And we haven't seen any major downgrades in these areas, nor have these stocks underperformed. So that's the crux why these stocks are falling here, in terms of GARP stocks.
And I want to also pick up on ITC, especially in the light of not just the numbers, but the hotel business demerger and now the swap ratio as well, which is out. Does it qualify, the rationale that you mentioned earlier, Vinod, avoid high optimism regarding the long-term prospects? I mean, ITC would surely qualify in that, wouldn't it?
Yeah, so when we say, is the price indicating that it is very excited about the long-term prospects, basically. So that actually translates into very high PE stocks, basically. So why do you get some stock which is trading at 80, 90 PE and something which is at 20, 30? Because for the 80, 90 PE stock, the market thinks that the long-term growth prospects will be significantly better. So the market is speculating on long-term growth prospects, but because the multiple that we apply is on the short term, in the next year or the year after that, the multiple comes up on that number. But since the number is so high, 80, 90 P is effectively telling you that the market thinks that beyond, let's say, FY25, the growth will continue to be very strong in the long term. So ITC, if you see, the P is not as high as you have for some of the high quality growth companies, which are very high P's.
Vinod, hi, morning. Just going through the list of the mid and the small cap GARP stocks. Just want to pick out a few of them and understand the overall growth potential and rationale. Say perhaps a Credit Access, Keval Kiran, Jyoti Labs here.
Yeah, so I mean, bulk of these stocks, if you see the earnings growth, they're clearly higher than the nominal GDP growth trend rate that we've seen, and they have also grown in the past. And the good part is that they are not seeing incrementally earnings downgrade or that kind of a thing. And the market is also willing to give them the kind of performance. So they are not underperforming with respect to the benchmark indices. So these are the key factors that the growth is higher than nominal GDP. Even the forecast is similar. And the multiples are not too expensive, right? And at the same time, the forward multiple on which, I mean, it is based on the forward earnings, that's not getting downgraded significantly, right? And it is not seeing significant relative underperformance. So these are the factors on which these stocks are scoring. That's why they figure.
Right, and getting your take as well of the entire auto sector. We've seen a number of new launches as well coming about. A lot of these auto ancillary stocks have been in the spotlight, and it has been a performing sector of sorts, Vinod. Is your sense that this traction is only here to stay?
Yeah, I think, see, if you see over the last couple of years, they have undergone significant challenges in terms of chips or other supply issues, basically, and demand also is coming back to normalcy. So I think, and the best part is the whole premiumization effort. If you see across, the excitement is only about new premium products, basically, and they are launching new products which are premium and has higher demand, as we saw for some of these new products which are launched. So I think, and the EV story continues. So a mix of low base, demand issues, supply issues, and new product launches, premium demand for high premium products. All these things augur well for this sector overall. Only thing is the valuations need to be reasonable, which are there for some of these stocks, as we mentioned. So yeah, they look good overall.
Okay, Vinod, thank you so much for taking the time out and highlighting the strategy on the GARP stocks which the House of ICICI Direct has identified. You know, since we're talking about autos, let's take that theme forward and let's try and understand what happened with Landmark Cars' earnings in the first quarter. Sanjay Thakkar, the chairman, joins in on the show right now to talk about how their quarterly performance was and the visibility going forward. Sanjay, hi, good morning. Good to have you on the show. Sanjay, just wanted to understand what really happened in the first quarter, because the numbers on a year-on-year basis comparable look significantly lower. Was there a one-off situation? Because you have talked about in the past also of non-availability of cars.
That's right. So thanks for having me on the show. The first thing that I want to say and reiterate is that the demand for premium and luxury cars remains to be strong and buoyant. Now, this is the need of the hour. If you have that, then a lot of other things will fall in place. As far as we were concerned, in the first quarter, the supply for variety of reasons with the different manufacturers that we represent, the situation wasn't that good. And I believe, and I'm pretty certain that that will change immediately. And I'll give you one or two examples. Mercedes-Benz, which continues to be our main driver of growth and business. The growth for the first quarter was 8% for the company. And this was because the non-availability of SUVs, mainly the GLC, which got launched last week, which is the world bestseller. And it is likely to be the bestseller for India. Now that the deliveries of that will start now. The high-end products, whether it is the S-Class or the GLS, continue to be in short supply. The situation hopefully is likely to improve going ahead. The Honda Elevate, which is the main product for Honda after many years, that will start kicking in from September. And I can go on and on. We represent manufacturers, and with us, it was a situation where the sales didn't happen to our satisfaction because of this, the factors that I told you. But the after sales business, which is our bread and butter business, an annuity type of a business, which keeps on growing at around 20% CAGR last 9 years. Now, this is something which clocked good growth. Our average revenue that per repair order also grew by like 9 or 10%. The company generated cash of around 20 crores, which is not that far from what happened in the last quarter of the same year last quarter. So there were some positive takeaways and there were some misses that way.
So, since you are so bullish about the after sales business, what number do you have in mind to close the financial FY24?
We have been growing at 20% for last 9 years, and we clocked around 190 crores this year. Last full year was around 750 crores or so. We are hoping that we will continue our long-term average and kind of go towards that. It's also a seasonality factor which plays out.
Sanjay, morning. Walk us through how demand is shaping up in terms of Q2 and beyond. What kind of order book build-up are you experiencing, keeping in mind the festive sales? And do you think that this time around we could see record festive sales?
It is most likely. For the auto sales, there is an inauspicious period which is ending on the 18th. And my hope is that after that, the demand situation will pick up even better. And we have a kind of a longish festive season this time with Diwali being in November, which always helps. So with the supply situation for us improving and this also kicking in, I'm hoping that we will have a much better Diwali. And last year, many people were asking me whether this was a pent-up demand. I continue to maintain that it's not a pent-up demand that we are addressing. We are looking at a structural change in India, where the car ownership continues to be at 2.2%, and the premium cars being only 1% of the entire auto sales, the luxury cars. So there is a long runway. We will have 1 quarter like this or 2 quarters like this, but it doesn't change the long-term trajectory of what we are building. And we are kind of to mention also building a third pillar for our profitability, which is that of the used cars. So if we have a quarter like this when the cars are not available, we do not suffer. We also have a third pillar to fall back on.
Okay, fair enough. And given that Gujarat and Maharashtra, a majority of your presence, I understand that 66% of the total outlets and the workshop, what is the plan to expand your sales further over there, or how different are the dynamics in terms of your sales expectations for these regions, these two states versus the rest of the regions?
Yeah, so our strategy has been, we are in business for last 25, 26 years, and our strategy has been to go deep in a geography. We go deep with a manufacturer where we become their largest partners wherever possible, and we have succeeded in most, and to go deep in a geography. So Maharashtra, what you are talking about, we entered as late as maybe 2016 or 17, and we have built our business. Then we have gone to West Bengal, Madhya Pradesh. We started our MG operations in Madhya Pradesh. We already have our Honda and Mercedes business over there. So once we enter a geography, we go deep in it, and we will also go to newer geographies. Newer OEs will get added as time kind of comes, and I believe we will see a larger portfolio and more states that we will be present in very soon.
I also wanted to understand about your relatively newer initiative, that of pre-owned car business. How's that doing?
It's early days. We are trying to crack something which nobody else has been able to crack. So that becomes a little bit of a mental block. But we have seen a lot of money-burning models. We have seen a lot of things which have not succeeded. So what we are doing is a very niche, well-thought-out strategy that we are planning out. And I'm, as of now, pretty confident that it will play out well. The focus will be to have the same customers in our fold, to have the same infrastructure, not adding to cost, and make a profitable business out of it.
All right. Thanks so much for taking the time out and giving us a view on how business is shaping up. Good to know that you're expecting a record festive sales this time round. All right.
Yeah.
Visuals on the side of your screens, and that is the D-Street debut of SBFC Finance. And remember, the expectation is that it is going to be a strong debut this time around. Okay, and there you have it at 82 rupees thereabouts is where it's listed. So that's a solid 43% premium against the issue price of about 57 rupees per share. That was the issue price. Do remember that the kind of response that we saw in the subscription numbers, the fact that the company has a pretty strong business model, asset quality has been stable as well. That is why we were going in with expectations that perhaps it would be a fairly decent premium to the issue price. Although earlier the expectations were it could even be a 60 to 70% premium, but given the fact that we have seen that mild correction in the markets as well, the expectations sort of tempered down. So there you have it. That's SBFC Finance listing at about a 43% premium to the issue price, 89 thereabouts versus the issue price of 57. All right, let's move right on from one corporate voice to another then and talk about the outlook for Senco Gold. And we've got with us Mr. Suvankar Sen, who's the Managing Director and CEO, as well as Sanjay Banka, the CFO of the company. Good to have you both on board. To begin with, then, Mr. Sen, give us a sense as to what demand trends were like in Q1, and do you think that this sort of 30% growth can be extrapolated for the rest of the year as well? Because it has been a strong quarter.
So see, the demand trend in the Q1 is driven by, the Akshaya Tritiya, which is an auspicious season for the jewelry buying customers. In many states, we have the new year that begins. And especially what we have seen is that after the bonuses that the people get after the end of the financial year, they usually try to use the bonuses to buy something auspicious. And then there was the summer wedding season, which also acted as a factor in which the growth was being led on. And one more thing that really helped on the growth for the jewelry sector was the fact that, government announced the HUID hallmarking to be done compulsorily. So there were a lot of customers who were trying to exchange their old gold jewelry and buy new jewelry with new HUID hallmarking done on the jewelry. So these were the various factors we saw that led to a very strong Q1 numbers. But at the same time, we will always, this is our first year of listing, and we would like to say that, we have seen that the H1 or Q1, Q2 usually has a very conservative approach in terms of their performances compared to the Q2, which is the festive season and the wedding season that comes in. And last year versus this year, while the Q1 numbers have been very good, but we must watch quarter on quarter on the performance on how the consumer demand continues to remain strong or it kind of becomes a little conservative. And accordingly, we should not just do a blank extrapolation of the whole year based on just the Q1 numbers.
Sure. Sanjay, what's been your reading on the financials and how Q1 has been and what the visibility for the full year is?
If you see the number, this year we have grown in terms of YOY, we have grown up by 29%. Now, this 29% growth has come in terms of gold and diamond both. So in gold, we have got a YOY growth of 22%, and in diamond, we have grown by 50%. And there is also a volume growth. So gold has grown by 8%. Diamond, as we said earlier, diamond has grown by 34%. So clearly, we are very excited by seeing the growth in this quarter. And as we say about the future, we are very excited about the future. So this being our first month, and if you see our growth in last few years, our CAGR was clearly among the best in the industry. We grew by 20% CAGR in last 3 years. Our LFL growth has also been very high at 22%. So we are very excited about the future, and we are sure that we will meet the expectation of the market and our stakeholders.
Fair enough. What is the outlook then, Mr. Sen, when it comes to your EBITDA margins? Because that has been under pressure during the quarter despite the increase in the studded share. What's the reason for that? And I just want to understand what is a sustainable level of your margins this time around. 5.1% is what you've clocked in, while in the past, the range has been 7 to 8%. Yes,
so we've seen a 0.9% of fall in the gross margins. It is led by the sales channel. We saw a lot of old gold exchange happening. Our franchisee, which has also grown, the share for their business has grown, but then the margins for the franchisee business are lower compared to the own store sales that we do. So overall, in terms of the products that are being sold, the channels that have seen the growth, we have had this kind of a 0.9% degrowth, but we will continue to see the festive season is up there. We should be optimistic, and we will have a range bound of a similar gross margin, ranging between 12.5% to 14%, 14.5%, based on the diamond sales growth that we see or the other channels that will pick up in the coming season.
So just to build on this, when we talk about EBITDA margin, our past EBITDA margin has been in the range of 7 to 8%, and we feel that the EBITDA margin will be in the range of 7 to 8%. So quarter one exactly is not the represent the structure of our margin for the full year. So let's wait for 2 more quarters. As we said that in quarter three, we get a full depth of our margin. So for the full year 23-24, we are confident that we'll maintain the EBITDA margin in the range of 7 to 8%.
Shumankar, let's talk about expansion, because previously you've talked about how you're seeing better demand in the northern region. Will you then continue to expand more in north and east regions, or is the strategy to diversify further and look at other areas as well?
No, our focus will continue to remain on east and north part of the country. As mentioned earlier, that we will continue to leverage the goodwill of the brand that we have already created in the eastern and northern part of the country, penetrate into the tier 2, 3, 4 cities of those zones. So that continues to happen, and we will do the same.
And what is the outlook then in terms of, Sanjay, your same-store sales growth in the quarter, and how do you see it shaping up for FY24?
So same-store sales growth in this quarter has been 22%. So out of the 29% YOY growth, and as we said that this year, the franchisee performance has really picked up as against last year. So we are very much hopeful and confident that the same-store sales growth will be in the range of 22 to 24%, and that's what will give us a good, solid full-year number as we proceed quarter on quarter.
All right. And also, can you tell us, Sanjay, how many stores is the company expecting to open then? And what is the outlook in terms of how many you would look to open on a franchisee basis, in particular in the Middle East?
So till now, we have opened 5 own company stores and 1 franchisee store. We have a very good pipeline of the franchisee store. We are seeing quite a very good interest in the franchisee, as the company has got listed and based upon our credibility. So we look at least 7 to 8 new franchisee store for sure. Our own store in the past, we have rolled out at least 8 to 10 stores. So since we have received the IPO funds, we are clearly looking at the numbers between 14 to 18 stores for sure. For the Middle East, no, we are still keeping our plan close to our chest. We have received the requisite approvals, and we are in the advanced stage of working on the same. We'll disclose it as the time comes.
Appreciate your time, gentlemen. Thanks so much for joining in and giving us a view on how things are shaping up at Senco Gold. So yes, they're optimistic about the festive season, looking at a 7 to 8% margin trajectory for the full year. Same-store sales growth has been about 22%, and the focus will be on the tier 2, 3, 4 cities. Tell you what, we'll slip into a very quick break then right here on the show. We've got lots more lined up on the other side.